professor of economics at Bentley University. So this is chapter 5, and we're going to be looking at the first of 2 videos in this chapter that focus specifically on the creation of money and the propagation of money. Now, this chapter is presented in the appendix to chapter 5. These videos, rather, this topic is in the appendix to chapter 5 in Michigan's macroeconomics textbook. So the objective of this video in this section is to understand what determines the money supply in the long run. So as I mentioned in previous videos, all of the early chapters in this textbook are focused on thinking about the mechanics of the economy over the longer term. So we're thinking about a horizon of several years or longer. And so as it turns out, in focusing on the money supply, we think a lot about the Federal Reserve and what their role is. And so they are just one of really 3 players in this process that actually helps determine what the money supply is. So there's really 3 players that go into thinking about the institutional factors behind changes in the money supply. The first are banks. As it turns out, that banks are really going to play a crucial role in the money supply process. Obviously, the Federal Reserve is a key player in that because they have the ability, as we'll see, to inject or pull reserves into and out of the banking system, which influences the money supply. And then also depositors. Depositors play an important role in this, and we'll see exactly the role that they play in terms of how the money supply is created and propagated in the economy. The main way in which we're going to think about the money supply being influenced is through what's referred to as open market operations. So this is very simply the Federal Reserve buying and selling bonds. So the Fed has a stock of U.S. Treasury bonds that it holds. It holds a lot of bonds right now of various maturities. And so if the Fed sells those bonds, then it's going to be pulling reserves out of the banking system and vice versa. And so by the Fed changing open market operations, it's going to be able to affect the amount of reserves in the banking system, which, as we'll see, has an effect on the overall money supply. And so to understand exactly the mechanics behind the creation of money and the money supply itself, it's instructive to use T accounts, which are effectively an accounting system. And so the basic idea here is through these T accounts, we'll be able to track how money flows through the banking system and actually creates the thing that we call money and that we can quantify as money. And so the basic intuition behind this, as I said before, is that banks play a really crucial role in the money supply and the propagation of the money supply. And the basic intuition is that banks are a financial intermediary which take in deposits from depositors. And one of the fundamental things that banks do with those deposits is they don't just sit on them and put them in bank vaults, but they loan some of those deposits out to others. And so that process of taking in deposits, holding some of it in reserves, and loaning out the rest becomes deposits at other banks, which then create more reserves and more deposits and so on and so forth. And so that creation of deposits through this, what's referred to as fractional banking system, is the thing that creates additional money beyond the initial changes that the Fed does at the front end. So to understand the process, as I said, we have to look at T accounts. And so we're going to look at the T accounts of the 3 players in this process: the Fed, the banking system overall, and depositors or individuals such as you and I. So if we look at the Fed's balance sheet, first of all, we have assets and liabilities. So the fundamental accounting 101 principle is that assets always have to equal liabilities. I'll talk about that in just a second. But when we think about the Federal Reserve, the assets that they have are basically twofold. The Fed can hold securities. So these are U.S. Treasury securities, government securities. They could be mortgage-backed securities. As I said before, the Fed holds a lot of these things right now on their balance sheet. And then the second asset that the Federal Reserve has are loans that it can provide to other financial institutions. Now, this is an asset because it has tangible value in the sense that, well, if a bank borrows directly from the Fed, it owes the Fed money. And so that is an asset in terms of the Federal Reserve. On the liability side, there's 2 basic liabilities: the currency that the Fed issues and the amount of reserves in the banking system that it issues. It turns out that currency and reserves are basically the same thing, but I'll talk about exactly what the distinction is between those. And so if you count up both all the currency and reserves in in circulation, then that represents the amount of liabilities by the Federal Reserve. In the banking system, again, on the asset side, banks can hold securities. So banks can have assets that earn returns like treasuries, like mortgage-backed securities, those kinds of things. Now, there are restrictions on the types of assets that banks can hold for various reasons because of risk and other things, but that goes beyond the scope of this discussion. But the basic idea is that banks can hold treasuries and mortgage-backed securities just like the Fed can. Banks also make loans to others. We can think of this as banks making loans to other banks, but in the aggregate, when we're thinking about the entire banking system, we don't really need to think about that. But banks can make loans to individuals as well, and again, that represents an asset to the banking system. And then finally, reserves, the amount of reserves that banks hold are an asset. So reserves are effectively money that banks hold in their vaults. Now, banks can also hold money in the form of reserves that are electronic accounts with the Fed. Okay, so just like you have electronic banking and you can go online and make transactions occur electronically, the banking system has that with the Fed, where the banks can deposit money electronically with the Federal Reserve. And so reserves to banks are simply money that's either in the vault or on account with the Federal Reserve. On the liability side, there's two basic liabilities that banks can have. The primary one, which is the focus of what we're going to look at here, are checkable deposits. So these are deposits that you and I have at our banks. So when we walk into a bank and we deposit money in our account, that becomes a liability to the bank because they're demand deposits. We can walk in there at any time and demand that money be returned to us, and the bank, of course, has to oblige. So the fact that it's money that the bank owes to us at some point means that this represents a liability to banks. And then the second type of liability that banks can have are loans from the Fed. So as it turns out, banks can borrow directly from the Federal Reserve through what's referred to as the discount window, and there's other ways that this can be done as well. And so because if banks owe money to the Fed, again, that represents a liability to individual banks, or more broadly speaking, the banking system. If we look at the non-bank public, so what we mean by non-bank public is essentially depositors. That's you and I. So we have several assets that we hold. So as depositors, we have money in banks. So that's one particular type of an asset. The second type of asset that we can have are currency. We hold cash in our wallets, so that represents a type of asset that we can use to buy goods and services with. And then the third type of asset are securities. So again, as individuals, we can invest our money in mortgage-backed securities or treasuries, just like banks do, and earn interest off of that. On the liability side, the primary liability that we have are loans to banks. And so if we want to buy a house or buy a car, we take out a loan, we owe that money to banks. And so that, again, from a financial standpoint, becomes a liability to us. So I'm going to run through some basic concepts and definitions to sort of set the stage for thinking about how we're actually going to use this to understand the money supply process. Open market operations, excuse me. Open market operations, as I said before, are essentially the buying and selling of securities by the Federal Reserve. And in this case, we're going to think of it primarily of buying and selling securities with banks. Okay, so banks are going to be the primary interface. Now, that doesn't have to be the case. As it turns out, banks can sort of indirectly interface with the public and the non-bank public and you and I, but it's just easier for the exposition of this multiplier process to understand the interface with banks. So if we have an open market purchase of bonds, the Federal Reserve is going to inject reserves into the banking system, and in return, the Fed is getting securities. So the amount of reserves go up in the banking system, the amount of the amount of securities that the Fed holds also rise. If we have an open market sale, it's the opposite. So in this case, the Fed is going to be selling some of its assets, treasuries or mortgage-backed securities or something like that. So that's going to be removing reserves from the banking system. Again, the reason why is the Fed is selling some of its treasuries to the banking system. The banking system pays for that by giving the Fed reserves. So the amount of reserves in the banking system go down, and the amount of treasuries that or securities that the Fed holds also decreases. So the monetary base, and this is going to be important to understand, is composed of two things. It's composed of the two liabilities that the Fed creates, currency and reserves. So when we add the amount of currency and reserves together, that comprises what's referred to as the monetary base. And what we'll see later on is that the money supply is going to be propagated. It's going to be a multiple of the monetary base, okay? So as I said, I sort of talked a little bit about these two things, the currency and reserves. It's important to sort of understand the distinction between these. So currency and reserves are basically identical. The idea is that they're cash, right? So to understand the distinction between currency and reserves, consider the following. If I walked into my bank with a $100 bill, when that $100 bill is in my pocket, it represents currency. It's cash that the non-bank public holds. But if I walk into a bank with a $100 bill and deposit that money into my banking account, once that deposit occurs, that money transforms from being $100 in currency to $100 in reserves. And so if you and I hold cash, that means it's currency. But if the bank holds cash, then that means it's reserves. And so money can seamlessly flow between currency and reserves simply by this process of money going from banks to a non-bank public and vice versa, okay? And so what we'll see later on is that means that the Fed doesn't really have control precisely over the composition of currency and reserves, but it has pretty precise control over the overall level of monetary base. And that, again, is directly a result of the fact that it can conduct open market operations in order to ensure that. So there's three things here that are important in terms of thinking about reserves. Again, this is money that's related to the banking system. Required reserves are just the amount of reserves that banks are required to hold on hand at all times, and this is a fraction of total deposits. So typically, this required reserve ratio is around 10% of all deposits in the banking system and all deposits at particular banks. It turns out that banks can hold more reserves than what's required to them by law, and so that represents the amount of excess reserves. So this is just the total amount of reserves that banks hold above what's required for the minimum. Now, historically, banks hold next to no excess reserves, but up until the financial crisis and a little bit into the financial crisis, the amount of excess reserves in the banking system skyrocketed. And so that's an important part of thinking about later on in the next video, how this might affect this multiplier process. And then the total amount of reserves in the system, it's just the sum of required and excess reserves. And so again, a little bit of accounting 101 before we get into the T accounting itself. As I said before, assets and liabilities must always match up. So the total amount of assets here has got to be equal to the total amount of liabilities. Now, for you accounting nerds out there, I know you're going to scream and say, well, wait a minute, assets is equal to liabilities plus net worth. Well, we're assuming net worth is equal to 0 here to simplify the way in which we think about this multiplier process. It fundamentally doesn't change anything. It just simplifies the way in which we think about the money flowing through the economy and being able to capture this multiplier effect. Okay, so here's the intuition behind this multiplier process. So when the Fed conducts open market operations, as I said before, that's going to either inject or drain reserves into and out of the banking system. And so that has a one-for-one impact on the monetary base, right? So if the Fed is changing reserves, the monetary base is going to be affected by exactly that amount, okay? So it turns out that the overall money supply can be different than the monetary base. Those are two separate things. And so as it turns out, the overall money supply, as we counted up in this chapter, can be magnified from the monetary base. And so the simple intuition here, as I led on before, is that when we inject reserves into the banking system, that leads to more loans being created, which leads to more deposits at other banks, which leads to more loans because of more reserves on the back end. And so those more greater loans mean more deposits at other banks, which then create more reserves, which are lent out, and so on and so forth. And so you get this multiplied effect on the money supply. So to see this, to create an example for this, let's assume that two things are true. And these are completely ridiculous assumptions, but in the next video later on, we're going to relax these assumptions. So first of all, let's assume that banks hold no excess reserves. The only amount of reserves they hold are required reserves. And second, let's assume that people hold no currency. So all the money that they have are in the form of checkable deposits in banks, okay? And so let's suppose that the Fed conducts an open market purchase of bonds from what we'll call First National Bank. So the Fed decides to inject $100 of reserves in the banking system, so it interfaces with First National Bank to buy this $100 security. So what happens is twofold. So if we focus first on what happens to the balance sheet for First National Bank, the amount of securities that First National Bank holds declines, right? So First National Bank sells the securities it has to the Fed. So the amount of securities that First National Bank holds goes down by 100. The flip side of that is that the amount of reserves that First National Bank holds goes up by $100, right? It has $100 more in reserves than it didn't have before. You'll notice, again, Accounting 101 holds here. Assets equal liabilities. The change in assets equals the change in liabilities here. So we passed our Accounting 101 exam so far. On the Federal Reserve System, if we look at what happens to their balance sheet, it's a little bit different. Assets are affected and liabilities affected. So on the asset side, the amount of securities that the Fed holds increases by $100. That's because it bought $100 worth of securities. So it's holding $100 more in securities than it did before. The flip side of this is that the Fed, the way that they paid for that was to create $100 in reserves, which is a liability to the Fed. So the amount of liabilities that the Fed created increased by $100, and those reserves are the reserves that went to First National Bank. Now, First National Bank has $100 in reserves that are free and clear. There's not any deposits backing this $100 in reserves. So First National Bank can hold on to these reserves, or they can loan all of these reserves out. Now, we're going to assume that the incentive here is for banks to loan this money out because they're going to earn interest off of these loans, right? And so they're not going to want to hold on to any excess reserves. All the reserves that they can loan out, they're going to. And so that's exactly what we're going to assume they do. So if we assume, excuse me, if we assume that First National Bank loans out this $100 in reserves, then you can see the reserves of First National Bank, the assets of First National Bank are transformed through that loan process. So First National Bank loans out $100 to whoever, doesn't matter. They go out and spend that money gets deposited at another bank we'll call Bank A, okay? So when that money gets spent and then deposited at Bank A, that creates a $100 liability in the form of deposits at that specific bank. Now what's backing, excuse me, what's backing this is that Bank A also has a $100 increase in reserves initially as a result of this new deposit, okay? Again, you'll notice that assets and liabilities are balanced in this balance sheet here. The question is, what does Bank A do with this? Well, again, the whole point here is that banks make money off of lending. And so the Bank A is going to want to loan as much of that money out as possible. So by law, Bank A is required to hold 10% of the deposits it holds on hand as required reserves. So that means that Bank A has to hold $10 in reserves, but it can do whatever it wants to do with the other $90 in reserves on this asset side over here. So what is Bank A going to do? It loans out $90 holds $10 as required reserves. And again, you'll notice that that transformation of Bank A's balance sheet still balances with the liability side and the asset side here. Okay. Now, one important thing to note here, again, we're talking about the loans and the fact that the incentive for banks to make loans is through the interest rate. We're not actually capturing the interest rate here. That's not an important part of the story in terms of understanding the multiplier effect. Okay. So we're abstracting from that just like we're abstracting from net worth. Those aren't central to the story here, so we're ignoring them. So again, we have this Bank A loans $90 out. That money gets loaned out to somebody who goes and spends it somewhere at a business. That business deposits it in its checking account at Bank B. Okay, so a new deposit is created at Bank B. And what's Bank B going to do with it? Well, again, it doesn't want to sit on the money that it doesn't have to. It's going to, I apologize if this is misaligned, but it's going to hold 10% of its deposits of $90, which is $9. So its required reserves are $9. And the amount of excess reserves is $81, whatever's left over, okay? So again, it's going to transform its assets into the following. Bank B is going to hold $9 in required reserves, $81 in loans. It loans out that $81. Both of those things, again, are balanced by and backing this deposit of $90. So when Bank B loans $81 out, again, that money gets spent. It becomes a deposit in another bank. We'll call it Bank C. The same process occurs. Bank C holds 10% of its deposits of $81, which is $8.10. The remainder, $72.90, is going to end up being excess reserves, which it's going to transform into a loan of $72.90. So this process continues indefinitely, presumably. Okay, so through these successive rounds of lending and deposits and lending and deposits and so on and so forth, you can see that this really represents a geometric sum, an infinite geometric sum. And so if we add up all these successive rounds, that's what gets us to thinking about what happens to the money supply. Initially, we started off with an injection of reserves of $100 from the Fed. The end result of this is excuse me. We have an increase in deposits in the entire banking system of $1,000. So that initial increase in reserves of $100 led to a 10-fold increase in deposits. Now, keep in mind, deposits are one component of the money supply, right? You have currency, deposits, traveler's checks, those kinds of things. And so those represent a form of the money supply. And so the takeaways are the following. So if we, again, assume rather boldly that nobody holds currency and banks don't hold any excess reserves, then the overall change in the money supply in this case is going to be dictated by the initial change in the initial change in reserves, which was the $100 open market purchase, divided by the required reserve ratio, which is $1,000. So with that $100 open market purchase of bonds by the Fed to banks, the amount of reserves and the monetary base increased by $100, exactly $100. But as we just saw, the money supply increased by $1,000, a 10-fold increase as a result of this. And so the total amount of deposits in the banking system increased by $1,000. And again, this is under the assumption that this required reserve ratio, excuse me, the required reserve ratio is equal to 10% or 0.1. So a couple of things to note here. So this process works in reverse too. If we were to conduct an open market sale of bonds of $100, in that case, the amount of reserves in the banking system would decline by 100, and so you would get $1,000 decrease in the total money supply. So the process would unravel exactly in reverse. And so the monetary base falls by 100, the money supply overall, over time through this indefinite process is going to reduce by $1,000 under these same assumptions. And so the punchline here is that bank deposits and that lending process are really crucial to the overall money supply and how the money supply is created. And so that's one of the reasons why the Fed is the primary supervisor of banks, of commercial banks. So they check over the banking system to make sure that they are operating under proper regulation and supervisory authority. So to summarize, if we look at the final impacts of this entire process, this is what the Federal Reserve's T account is going to look like at the end of the day. So it's nothing special here. This is the initial impacts. And once the initial impacts occur for the Fed, that's it. All of the magic happens on the banking side and with the non-bank public. So if you recall, First National Bank started us off with selling securities it had to the Fed, getting extra reserves as a result. Excuse me, I apologize. Getting extra reserves as a result and loaning that money out. That started this process of this magnification process. So at the end of the day, you and I, the non-bank public, we saw the amount of deposits that we had in aggregate increase by 1,000. The flip side of that is that we borrowed $1,000. So again, for the non-bank public, that's what how the balance sheet is balanced and taken account of. If we look, excuse me, if we look at the overall banking system, again, we have $1,000 in new deposits created in liabilities of the banking system in total. It drew down $100 in securities through that initial effect of the First National Bank. Its loans went up by $1,000, and it had an increase in $100 in reserves. Now, keep in mind, these reserves are now spread throughout the entire banking system. They're all required reserves, and they're all spread throughout the entire banking system at all different banks. Okay, so not one bank is holding all of this, but it's all banks in aggregate. So when we look at this overall banking system, again, what we're doing is we're, excuse me, what we're doing is we're adding up all the assets and liabilities of all of the banks that are involved in this process. First National Bank, Bank A, Bank B, Bank C, Bank D, and so on and so forth. And so once this multiplier process comes to fruition, that's what we end up with. So there's some obvious limitations of this simple multiplier model that we've looked at. And this comes down to the very basic assumptions that I started off with. It turns out if people hold currency, and they do, I have a few dollars in my wallet, just a few, of course, then the multiplier is going to be less than the one that we just demonstrated here. So if the required reserve ratio is 10%, as we saw in this simple example, you get a 10-fold increase in the money supply. It turns out if people hold currency, the multiplier is going to be less than that 10-fold increase. And the basic intuition is that if more people are holding currency, then that means that there's less people holding deposits. That means there's less reserves for banks to be able to lend out. And so that dampens or mutes this multiplier effect. And similarly, if banks hold excess reserves, and currently, at least for the last several years, they've been holding a lot of excess reserves, again, the multiplier process is going to be a lot less than what this simple example predicts of a 10-fold increase. And again, the intuition is similar. If banks are holding excess reserves, they're necessarily not making loans, which aren't becoming deposits at other banks, which then create more loans and deposits downstream. And so that mutes this effect of, of the simple multiplier model. So in the next video that you'll see, we're going to address these assumptions and see that there's a slightly more refined model, this multiplier model, to be able to try to understand better the mechanics of this process of currency holders, the bank depositors, and the Fed behavior, and how that all comes together to affect the money supply in a more coherent model. Thank you.